Welcome to Financial Management Unit 7 Capital Structure. Here in this unit we will understand the different ideal capital structure, the factors that affects the capital structure. We will also understand in this module the various theories of capital structure. The various theories when I am talking about, here we will discuss about net income approach, net operating income approach, traditional approach, Miller and Modi-Giuliani approach, and the basic assumptions of Miller and Modi-Giuliani approach, that is approach. This module plays a very important role in financial management. Let's begin with today's topic. When I say capital structure, what strikes to your mind? What is the first thing that comes to your mind? Yes, the capital structure of a company refers to mix of long-term finances which is used by the firm. Very right. And in short, it is financing plan of the company. If I have to say in short, it is nothing but a financing plan of the company, that is called as capital structure. Now we'll see what is a book definition of capital structure. In finance, capital structure refers to the way a corporation finances its assets through some combination of equity, debts or hybrid security. A firm's capital structure is then the composition or structure of its liability. So in other words, in a layman, in a short, it is a financing plan of the company with the objective of maximizing the value of equity shares, right, or some other debt and equity pattern, right? Okay, after understanding the capital structure, we'll move further. When I talk about the capital of a company, capital structure, what are the features that this ideal capital structure should have? A good capital structure of a company, the funds of the company, finances of the company should have what ideal features? As it displays in this slide: profitability, flexibility, control and solvency. Let me ask you, what do you understand by profitability? When I say profitability, the ideal capital should give a good profit to company and to the investor. So in the layman terms, if I have to say, I can say ideal capital structure should be flexible, should be giving a maximum profit at a very minimum cost. So the firm's profitability, if I am talking about, the firm should make maximum use of leverage at a minimum cost. They should use maximum benefit without paying a very minimum cost. Is a profitability. The company should have enough return on those leverages. Next, flexibility. So what's the meaning of flexibility? It's flexible. The money should be flexible enough, right? Now what flexible we are talking about? And ideal capital structure should be flexible. When you say, it means what? It means that an ideal capital structure should be flexible to adopt the changing condition. Changing condition refers to the raise of funds at the shortest possible time and also repay the money which is borrowed. That means that flexibility means I should be able to generate my money in a shortest possible time. I should be able to repay it whenever I want. I can borrow it. That means it should give a funds raise in a very short time. That's a flexibility. Now if I am talking about the control, that means my capital should be under my control. It should have a minimum dilution. I should not be investing like a vague investor my capital, wherein whenever I want I cannot change my funds, I cannot diversify my funds. It should be fully under my control. It should not be under the supervision or the control of an external power, right? And then is solvency. We all know solvency means profitability, soundness of the company. Always remember, the excessive debt threatens the very existence of the company, because debt might not give you the return what you are expecting. It gives a fixed rate of interest. In other words, it's a very low rate of interest. However, in the equity market, it gives a very high rate of interest. And then there is a risk too. So when I say solvency, you need to understand, any additional debt involves huge repayment. And the loan with a high rate of interest are to be avoided, because the income what you have will be invested into the, not invested, rather it would be paid as an interest. So you should always remember that you should have solvency enough, you should have capable enough, your solvency ratio should always be higher side, you should be sound enough to have a profitability of the company, right? So what are the features of an ideal capital structure? It should be profitable, it should be flexible enough to borrow and to raise the funds, should be under your control, and you should have solvency. You should have solvency margin with you. You should have sufficient money with you. Now, what are the factors that affect the corporate or a capital structure? The first factor that affects is a leverage. Leverage affects a lot to the capital structure. Let's understand, the other factor that can be considered for ideal capital structure would be cost of capital. Leverage is one thing what we discussed earlier. You should be leveraging the funds to the maximum of your profit. We will also discuss over here the other factors that consider for the capital structure, that is cost of capital. Cost of capital we discussed in our unit 5. We also discussed cash flow in our previous sessions. Let me explain you what is cost of capital. As a corporate, you should always avoid high cost fund. The reason is, high cost fund will have a very high cost involved in it. So you should avoid high cost of capital. Cash flow projection of the company. When I say cash flow projection is nothing but your decision should be taken in the light of your cash flow projected for the next 3 to 5 years. You should not project your capital structure in such a way like 10-15 years, or maximum 3 to 5 years projection. As a professional, you should not get carried away by the company result or your experience. Should be practical enough to have your projection. You should not be taking any decision on the vague. Your projection should be practical projections. And the third is dilation of control. That means that the management should have a flexibility to take appropriate decision at a right time. It should not be dilution of the control. They should be capable enough to take a right decision at a right time. And when I say flotation cost, what do you mean by flotation? What do you mean by flotation? Something floating. Okay. Here the flotation refers to a company when deserving to increase its capital. जब भी मुझे अपने capital को बढ़ाना है, debt या equity के through, I will be able to do that. When I have to desire to increase the capital, I can increase my debt, I can increase my equity, which incurs the cost. जब मुझे अपने फंड्स को बढ़ाना है, चाहे मैं डेट में डालूं या इक्विटी में डालूं, उसके अंदर कोई ना कोई कॉस्ट इनकर होगी. इस कॉस्ट को कहते हैं फ्लोटेशन कॉस्ट. और इस तरह के कॉस्ट को हमेशा शुड बी कंपेयर विद द प्रॉफिट एंड द राइट डिसीजन टेकन. फ्लोटेशन कॉस्ट होती है कंपनी के प्रॉफिट से रिलेट करके देखना है आपको, कंपनी की कितनी प्रॉफिट हो रही है और आपकी फ्लोटेशन कॉस्ट कितनी हो रही है. पता चले आपकी कंपनी की प्रॉफिट कम है, फ्लोटेशन कॉस्ट बहुत ज्यादा हो गई है, बिकॉज जो आप फंड्स को डाइवर्सिफाई करते हैं इसके अंदर जो कॉस्ट ऑफ मनी इन्वॉल्व है, इसके अंदर ट्रांजैक्शन चार्जेस है वो बहुत ज्यादा आते हैं. तो फैक्टर्स ऑलवेज रिमेंबर दैट इफेक्ट्स टू योर कैपिटल स्ट्रक्चर इज, first is leverage and further it is divided further, that is cost of capital, cash flow projection of the company, dilution of control and flotation cost. That means that cost of capital जो हमारी है, ज़्यादा high cost capital को avoid करना है हमें. And company 3 से 5 साल के, when I talk about cash flow projection, a company should think about 3 to 5 years. एक long term projection नहीं लेकर के चले 8-10 के साल के लिए, because all the projection should be a practical projection. Hypothetical projection नहीं होना चाहिए, क्योंकि hypothetical होता है तो affect करती है capital structure को. Dilution of control, that means that top management जब चाहे जब immediate decision ले सके, they should be flexible enough to take a control on the funds. लॉन्ग टर्म इन्वेस्टमेंट रहेंगे तो कंट्रोल में नहीं रहेंगे, शॉर्ट टर्म रहेंगे तो वी कैन इमीडिएट लिक्विडेट द फंड. फ्लोटेशन कॉस्ट, हम जब फंड्स रेज करना है इक्विटी या शेयर्स में जब इन्वेस्ट करते हैं तो हमें उसकी कॉस्ट जो इन्वॉल्व होती है वो होती है फ्लोटेशन कॉस्ट. हमें फ्लोटेशन कॉस्ट को कम से कम रखना चाहिए. राइट, सो वी हैव अर्लियर अंडरस्टूड द टू थिंग्स. वन वाज फीचर्स ऑफ एन आइडियल कैपिटल स्ट्रक्चर. क्या थे फीचर्स? प्रॉफिटेबिलिटी, फ्लेक्सिबिलिटी, control, solvency, correct? And then we understood the factors affecting the capital structure. कौन-कौन से factors हैं? Leverages, cost of capital, cash flow projection of the company, dilution of control, flotation cost, right? And what after this? Yes, after this we will refer to various theories of capital structure. My dear friend, when I say theory of a capital structure, all these 4 theories are important. Let us understand one by one each theories in capital structure. There are primarily 4 capital structure theories. The first theory, which is called as net income approach. When I say net income approach, what is the meaning of net income? The income after paying all taxes and liability. Actual profit after taking out all the expenses are called as net income. So net income approach is what? This theory talks about what? Something related to net income. So net income approach is suggested by Durand. This approach is suggested by the Durand. This theory is in form of approach and it was suggested by Durand. And he is of the view that the capital structure decision is relevant to the valuation of the firm. When I say valuation of the firm, the value of the firm, the capital value of that firm, any change in the financial of this company will directly leverage to a high corresponding change in overall cost of capital and also the total value of the firm. As a result, the net income, if I am talking about, is a final income what I have in hand, company I have in hand. So net income approach income is suggested by whom? It is approach suggested by Durand. And what is his view? His view is that capital structure decision is relevant to the valuation of the firm. Valuation जो मार्केट में कीमत लगाई जाती है फर्म की. नेट इनकम अप्रोच वो होता है जो कंपनी के वैल्यूएशन के ऊपर लगाई जाती है. कोई भी अगर आप चेंज करते हैं वैल्यूएशन के अंदर, कोई भी फाइनेंशियल को लेवरेज करते हैं, उसका डायरेक्ट इफेक्ट ओवरऑल कॉस्ट ऑफ कैपिटल के ऊपर पड़ेगा. कोई भी वैल्यूएशन गलत होने से या कोई भी छेड़छाड़ जो वैल्यूएशन में होती है वो डायरेक्ट कॉस्ट ऑफ कैपिटल पे रेफर करती है. क्योंकि अगर कंपनी की गुडविल को आपने हाई रेस कर दिया, कॉस्ट ऑफ कैपिटल बढ़ गई. गुडविल को अगर कम रेट किया, इट डायरेक्टली इफेक्ट्स टू द overall cost of capital. So net income approach is suggested by Durand, and he suggests that the decision is relevant to the cost of firm, the relevant valuation of the firm. There is any change in the financial leverage will have corresponding change in overall cost of capital and also the total value of the firm. Any question on net income approach? Now, we'll move to the next theory, that is net operating income approach. When I say net operating income approach, what do you understand? In net income approach, you know, it is suggested by Durand and he always says that it is based on the capital valuation of the company. Any valuation change will have a high impact on the cost of capital. That is what net income approach is. Now if I say net operating income approach, what comes to your mind? Okay, let me explain you now. Net operating income approach is again propounded by Durant. It was approach earlier, net income approach is proposed by Durant. Here net income approach is propounded by the Durant, and it is always opposite to the net income approach. It is totally against net income approach. Net operating income has a different view of a net income approach. Here what Durant says, earlier he said that any change in the valuation will have a direct impact on the cost of capital under net income approach. Under net operating income approach, Durant says that any change in the leverage will not lead to any change in the total value of the firm. In net income approach, it says that it has a direct impact. In net operating income, it says it does not have any effect on the valuation of the firm or the market price of the share. Right? Because here it is income and here is a operating income, that is expenses on operations. So, the overall capitalization rate is the same for all degree of leverages. Here in net operating income, it says it does not affect for the valuation of the firm, will not affect to the capital or overall operating income of the company. He says that any change in the leverage will not lead to any change in the total value of the firm, market price of the share or the overall cost of capital. Right? That is net operating income approach. Any questions before we go to the next? That is traditional approach. Before going to traditional approach, let me tell you once again, recap. Net income approach was suggested by Durant. Net operating income is propounded by the Durant. Net income approach says any valuation change in the valuation of the firm will have a direct impact on the cost of capital. Net operating income approach says it will not have any effect on the cost of capital. Now traditional approach says the net income will remain constant unless the certain degree of leverage and thereafter rises at the income rate. What it means to say? Traditional approach has two propositions. First is here net and income is constant until a certain degree. Traditional approach says net income, the first approach what we have here, it will remain constant up to certain degree of leverage and then after rise to increase rate. Up to certain level the income will remain same and after one particular point the income will keep rising. First proposition. Second proposition under traditional approach says net operating income approach remains constant or rise gradually until a certain degree of leverage and thereafter rise very sharply. So two primarily approach, traditional approach has two propositions. First it says net income approach will remain constant. It will not affect up to one particular limit. Okay, and then after it changes drastically. And the second proposition what it gives, the traditional approach, is that net operating income will also remain constant and it rises gradually after a particular point. Okay, and it rises very fast, sharply. Right? That is what the traditional approach is. However, the most important approach in a capital structure is Miller and Modigliani approach. It is also called as MM approach. I repeat, Miller and Modigliani approach is also known as M&M approach. Here henceforward, we will refer Miller and Modigliani approach as M&M approach. Right, friend? Here we go. Let's understand what is Miller and Modigliani says. They are in the opinion of criticize that the cost of equity remains unaffected by leverage up to the reasonable limit. Miller and Modigliani says that they criticize on the cost of equity that remain unaffected by leverage of reasonable limit. What they say is that the cost of capital will always be affected once it is leveraged to a certain limit, right? That means net income constant, and it says that net income remains constant at all degree of the leverage. The two things. What it says is, first, Miller and Modigliani criticize that the cost of equity remain unaffected. They says no, it will always get affected by the leverage of up to a reasonable limit. Not every time, up to a certain limit it will be okay. It will be affected. However, net income approach remains constant at all degree of leverage. Net income approach remains constant to all degrees. However, net operating income approach will always remain unaffected by the leverages. These are the two approaches given by the Miller and Modigliani. However, you need to assume that this approach is based on certain assumption. There are certain assumptions for Miller and Modigliani approach, and let's understand what are the assumptions. The assumptions of Miller and Modigliani approaches, first is perfect capital market. What they say is securities can be freely traded. It cannot be freely traded. Securities can be freely traded. That is, investors are free to buy and sell the security. That means there would be no interest on the borrowing. However, it is not possible. There are certain interests, there are certain rules for the perfect capital market. Security cannot be freely traded. But here Miller and Modigliani approach has a assumption that perfect capital market. They assume that this will be perfect okay if the security is being freely moved. It can be easily borrowed and sell in the market. That is what he says, the perfect market capital. Second assumption is he assumes that investors behave rational. They choose the combination of risk and return which is the most advantageous to them. They have assumption that they have chosen risk and the return. They are always in the favor of investor, which may practically be not possible. The third is homogeneity of investors' risk perception. When I say homogeneity of investors' risk perception, means all investors have the same perception of business risk and return. Is it possible that all business will have same level of risk and return and the same level of return? Might be, may not be. So this homogeneity of investor risk perception is not common or near not same to all type of industry, all person, all business. Again, it is based on the assumption. And the fourth is taxes. This is based on the fourth assumption that there is no corporate or personal income tax. There would be always effects of taxation of this industry. It plays a major role. And the fourth is dividend payout is 100%. This theory, Miller and Modigliani approach, is based on the fifth assumption, that is dividend is paid out 100%. The firm do not retain earning for future activity. That company will not keep any money with himself. Whatever the company has of profit will be given to the investors or to the equity shareholders. It's not possible. The company has to retain some form of some money with them. So, Miller and Modigliani approach. So the Miller and Modigliani approach is based on 5 assumption. First assumption is perfect capital market. Investor behave rationally. Third is homogeneity of investors' risk perception. Fourth is taxes. Fifth is dividend payout is 100%. Can I repeat once again? These are based on the 4 assumptions. First assumption is perfect capital market. What do you understand by perfect capital market? Perfect capital market, it means that securities can be, the assumption is that securities can be traded freely in the market. There is no hindrance, there is no restriction of buying and selling in the securities. This is what the first assumption is, which is practically not possible. Second assumption is investors behave rationally. Investors never behave rationally, it's an assumption. The choice of combination of risk and return, which is the most advantageous to them. Third assumption of Miller and Modi-Giuliani approaches, homogeneity of investors' risk perception. Here he assumes that all investors have the same perception of business risk and return, which is not possible. Every business, every industry has a different risk, it has a different returns. You cannot assume that all type of industry, all segment will have the same risk and the same return. Because the type of customer is different, customer profile is different in industry. So this assumption is again applicable to Miller and Modi-Giuliani approach. The fourth approach is taxes. He assumes that there is no corporate or personal income tax. Do you believe in country like India that a businessman can survive without paying income tax? बिजनेसमैन के अलावा इंडिविजुअल को भी टैक्स पे करना पड़ता है, जिसे हम कहते हैं इंडिविजुअल टैक्सेस, इनकम टैक्स. डू यू थिंक इन इंडिया आप किसी तरह से अपने टैक्स को बचा करके बच पाएंगे इंडस्ट्री में? However, Miller and Modi-Giuliani approach specifies that this is based on the assumption that there is no corporate or income tax. And the last approach is dividend payout, which is 100%. No company will pay out the dividend of 100%. The company will keep certain amount reserved with themselves for the contingency payout. So these 5 assumptions are important for Miller and Modi-Giuliani approach. Any questions, friends, before we move further? Can we summarize what we have learned today? We have started with financial capital, capital structure. In finance, capital structure refers to the way of corporation finances. If I have to say in a layman terms, capital structure, the capital structure of a company refers to the mixed long-term finances used by the firm. In short, financing plan, it is nothing but a financing plan of a company. And features of an ideal capital structure is, it should be profitability, it should concern on flexibility, it should be concerned on control, and the last is solvency. Now what are the factors affecting the capital structure? First is leverages. Under that we have done the cost of capital, cash flow projection of the company, dilution of control, flotation cost. Then we discussed theories of capital structure. The first is net income approach, second is net operating income approach, third is traditional approach, and the last and but not the least is Miller and Modi-Giuliani approach, which is also called as M&M approach. Now we discuss assumption of Miller and Modi-Giuliani approach, and the assumption first is perfect market. It is based on the perfect capital market. Investors have behave rationally. Third is homogeneity of investor risk perception. The fourth is tax. Fifth is dividend payout is 100%. Any questions, friend? No questions? Thank you and have a great learning. Enjoy yourself, and I am sure this module will help you to become a more financial expert. I would rather say a professional financial expert. Thank you. Take care.